Okay, let's dive in. Welcome to this deep dive. We've been digging into the material from Genesco's first quarter fiscal 2026 earnings call.
Right.
And our goal here is really to cut through the noise, pull out the key takeaways for now.
Yeah, get you quickly up to speed on their performance, their strategy, and what they're seeing ahead.
Exactly. So first impressions, what was the overall vibe from management?
Well, the overall picture, they seem quite pleased, actually.
Yeah.
Pleased with the start to the fiscal year. Both sales and operating income came in nicely above what they were expecting.
Okay, good start then. Let's get into some specifics. Q1 financials.
Yep. Total revenue was $474 million. That's up about 4% compared to last year.
And what drove that?
Really is the comparable sales performance. Overall comps were up 5%. And this is actually the third quarter in a row they've seen positive comps. So some momentum building there.
Third quarter, okay. How did that break down between stores and online?
Pretty solid across the board. Store comps were up 5%. And they're direct to consumer, so online mostly, was up 7%. Even wholesale grew, up 5% as well.
Interesting. And what about the bottom line profitability?
That was another positive area they highlighted. They managed to get operating expense leverage by 170 basis points.
Okay, 1.7%. What does that mean exactly? Leverage here.
It basically means their operating costs grew slower than their sales did. So they became more efficient. They pointed to their ongoing cost reduction efforts really helping there.
Got it. So higher sales, better cost control, that should lead to better operating income, right?
Exactly. It led to improved operating income and earnings per share compared to last year. Now, they still had an adjusted operating loss for the quarter, but it improved. It was $28 million this Q1 versus a $30 million loss last year.
An improvement, even if still a loss. And earnings per share.
Similar story. The adjusted diluted loss per share came in at $1.25. That's a pretty significant improvement from a loss of $2.10 in Q1 last year.
Okay, nearly half to the loss per share.
Yeah. And they did make a point about that EPS number. They said it actually would have been about 5 cents better.
Oh, why wasn't it?
Because they did some opportunistic share buybacks during the quarter.
Ah, right. Buying back shares when you have a loss makes the loss per share slightly worse because there are fewer shares to spread it across, dilutive.
Precisely. Dilutive in a lost quarter, but they expect those same buybacks will be accretive, meaning they'll add to earnings per share over the full year, assuming they hit their profitability targets. It kind of shows their confidence,
Yeah, a signal about their longer-term view. Okay, so that's the big picture. Let's maybe unpack the different parts of the business. Where should we start?
Let's definitely start with Journeys. That was the real standout in Q1.
Right, I saw that Journeys comps were up.
Right.
What was it?
A strong 8%. And like we said about the overall company, this was Journeys' third consecutive strong positive quarter too. Management sees this as sort of the early results of their strategic plan really kicking in.
And what is that strategic plan focused on for Journeys?
The core idea is strengthening its position with teens, but with a sort of enhanced focus on the teen girl specifically.
Okay.
They talked about seeing a much bigger opportunity there, serving what they called a style-led teen audience that wants a diverse mix athletic, casual, fashion footwear. They think that market is maybe 6 or 7 times larger than the one Journeys traditionally focused on.
Wow, 6 or 7 times. So they're aiming for a much bigger piece of the pie. How's that translating into sales drivers?
Well, the performance was pretty broad-based. They had 7 different brands across both athletic and casual that posted double-digit gains.
7 brands, double digits. Nice.
Yeah, athletic brands were the strongest driver within that. And get this, athletic now makes up more than a third of Journeys' total footwear sales. That's a big shift.
Definitely. What's enabling that shift? Is it just bringing in more sneakers?
It's partly that, but also what they call product elevation, bringing in hotter brands, more sought-after styles. And that's letting them charge more. Average selling prices for footwear at Journeys jumped 12% in Q1.
12% ASP increase, that's significant.
It really is. They mentioned bringing in brands like Hoka and Sakagu, which are obviously very popular right now. And they're also seeing good response to trends like low-profile styles and those 2000s-inspired running shoes. That's helping offset some continued, softness in the more basic canvas shoe area.
Makes sense. So even if overall shopper traffic is maybe a bit weak sometimes.
Exactly. They saw really strong gains in-store conversion, people actually buying when they come in, and also in transaction size, how much they spend. So people are finding what they want and buying more of it. That helps make up for maybe fewer people walking through the door on slow days.
And are they managing inventory to support this? With hot brands, you need the stock.
They are. They mentioned inventory was up 15% year over year in Q1, but they stressed this was building off really low levels last year, so it's about having the right product available to meet that demand they're seeing.
Okay. So product is key, but is there more to the Journeys turnaround story?
Oh yeah, definitely. It's not just the shoes. They're investing heavily in the Journeys brand itself, updating positioning, imagery, using influencer marketing, social media.
Like TikTok stuff.
Yeah, they even called out that viral Jasmine Bigfoot series on TikTok, said it got like 44 million views. So they're connecting in new ways. And they've got a big new campaign planned for back to school.
And loyalty. Are they building that direct customer connection?
They are. Almost 7 million new loyalty members added in the last couple of years. That's a valuable asset.
Okay, but what about the physical stores? Any changes there?
This was maybe the most impressive part. The new 4.0 store design.
Yes, the remodels. What are they seeing there?
Really exceptional results. They said these remodeled stores are delivering a sales lift of more than 25% compared to the standard stores.
25%. Wow.
It's a combination of things.
Yeah.
Better traffic flow in the store, higher conversion rates, higher average selling prices because the product looks better and is more elevated, and crucially, they're attracting more new customers to the brand.
That sounds like a home run. How many do they have?
They ended Q1 with 39 stores in the 4.0 format, and the results are so good they're actually accelerating the rollout. They pulled forward some remodels and now expect to have over 75 done by the end of this fiscal year.
Makes sense if the return is that strong.
Totally. And one last piece on Journeys, they also mentioned focusing on their people. Better training, better selection of associates, which they believe is also helping drive those conversion gains in stores.
Okay, a multifaceted approach at Journeys, clearly paying off. What about the other parts of the business? Let's talk about SHU, the UK business.
Right, SHU. They saw comps increase in the low single digits. That's the second quarter in a row for them.
Okay, positive momentum there too. It's slower.
Yeah, benefiting from similar themes, actually brand elevation, better product mix, and critically for the UK market, getting better access to top brands and styles. They're trying to position SHU as a key spot for youth casual and athletic over there.
Digital doing well there too.
Yep, digital sales, outpacing stores, and the kids business was also strong. And they specifically mentioned getting much better product allocations from partners like Nike and New Balance for SHU, which should help going forward.
Good to hear. Okay, what about Johnston & Murphy, J&M? That brand had been on a tear.
It had 2 years of record sales after they repositioned it towards more casual and comfortable lifestyle stuff.
Yeah.
Q1 was a bit different, though. Comps were down 2%.
Ooh, a pullback there. Why?
Well, it's interesting. Even with comps down, they still saw growth in store conversion and transaction size.
So, like Journeys, the people who did shop bought more or were more likely to buy.
Exactly. Suggests the product assortment, especially the new stuff, is still resonating. The weakness wasn't really in their main stores or online. Those were actually slightly positive on comps. The drag came from their factory outlet stores.
Ah, the factory channel. Maybe a more price-sensitive customer there feeling the pinch.
That's what they implied. That customer pulled back more significantly. But they did highlight some product successes, like the Andrew sneaker being a top seller, and their Upton dress shoe line making a comeback.
So what's the plan for J&M now?
They're continuing to push on innovation and accelerating that brand repositioning. They've got an updated brand book. They're doing a 175th anniversary campaign and collection, shifting marketing spend, and planning some new store openings in the back half to build awareness.
Okay, makes sense. And the last piece is the branded group.
Right. The Genesco Brands Group, their own brands and licensed stuff. They're continuing to simplify the licensed portfolio, which they say is helping. New product is apparently resonating.
But how are sales?
Q1 sales actually got a bit of an artificial boost from pulling forward some sales related to licenses that are ending later, basically shipping stuff early.
So not sustainable growth there.
No, and they guided as such. They expect sales for the brands group to be down high single digits for the full year. That reflects managing those license expirations and also navigating the tricky wholesale environment, especially with the tariff uncertainty.
Right, tariffs. That seems like a good pivot point. Let's talk about the macro picture and those headwinds. They mentioned the consumer being choppy and selective.
Yeah, that was the term they used. Meaning, consumers shop when there's a reason, holidays, specific deals, but pull back otherwise. And when they do shop, they're very focused, looking for must-have items, freshness, newness.
So not just browsing casually.
Less so, it seems. But their experience shows that if you offer the best brands and the really coveted shoes, customers will engage.
And they made an interesting point about price points, didn't they?
They did. They said, unlike maybe past downturns where people traded down, right now they're seeing customers actually stretching up, paying more to get the specific item they really want. That Journey's 12% ASP increase kind of backs that up.
Fascinating. Okay, now the big one, tariffs. What's the situation there?
Huge topic, obviously. They stressed their, track record of navigating this stuff before and laid out their mitigation plans. First, they pointed out their exposure to China sourcing is already limited and shrinking less than 10% of products subject to these tariffs.
Only 10%. That seems manageable.
Relatively speaking, yeah. And about half of that is in their branded business. They also said they could get almost completely out of China sourcing quickly, if needed.
Okay. What's the potential dollar impact they mention?
They estimated that without any mitigation, the cost increase from these reciprocal tariffs in the branded business would be roughly $15 million this fiscal year.
15 million. So what are they doing to avoid that hit?
A few things. Managing inventory carefully, maybe accelerating orders to get ahead of tariffs, or even canceling some. Diversifying suppliers more, shifting production to lower tariff countries, working with their factories to cut costs.
And price increases.
Yes. Planning strategic price increases, mostly targeted for the back half of the year. And they'll invest in marketing alongside those to drive demand. Importantly, they said they do not expect to just eat that cost and take a hit to gross margin.
They plan to offset it, but the big question is always consumer reaction, right?
Absolutely. That's the biggest unknown. How will consumers respond to potentially higher prices on top of existing inflation? They acknowledged that requires constant dialogue with their brand partners, but overall, they sounded pretty confident they can navigate it and offset a good chunk of the impact this year.
Did they comment on all the M&A happening in the footwear space?
Briefly, they noted most of it has been on the performance athletic side. They feel their focused lifestyle, style-led teen across different categories is distinct, so they feel good about their specific lane, especially at Journeys.
Okay. Let's shift back to some more financial details. SG&A costs. How do they manage those?
Selling, general, and administrative costs. They actually did better than expected there. SG&A was 52.5% of sales. That's 170 basis points better than last year.
Nice improvement. What drove that?
Mostly lower rent and occupancy costs, reduced bonus expense, and just general benefits from their ongoing cost-saving programs. That partly offset by spending more on sales and marketing, but the net effect was positive leverage.
And store count. Are they still closing stores?
They are. They ended Q1 with 12,256 stores, which is net 65 fewer than a year ago. But they pointed out these closures were about 5% of the store base, but only represented about 1% of total revenue.
So closing the less productive locations.
Exactly. Generally accretive to profit, and they even saw some sales transfer to nearby stores or online.
Makes sense. Capital allocation, where's the money going?
Primarily into those Journeys 4.0 remodels we talked about.
Yeah.
Total capital spending in Q1 was $19 million, mostly retail stores and related tech. They mentioned having a strong balance sheet and good liquidity, so they have the capacity for these investments.
What about free cash flow?
That was negative in Q1. Negative $120 million, which was a bigger use of cash than last year's negative $40 million.
Why the bigger drain this year?
Two main reasons they gave. One, that strategic inventory builds, especially at Journeys, getting that hot product in stock. Remember, inventory was quite low last year. Two, higher capital spending this year because they're ramping up those store remodels.
Okay, so investments in inventory and stores. Do they expect positive free cash flow for the year?
Yes, they do. Despite the Q1 usage, they forecast positive free cash flow for the full fiscal year, and they expect it to be higher than what they generated last year in FY25.
And share buybacks, you mentioned those earlier.
Right. They bought back about 605,000 shares in Q1, roughly 5% of their outstanding shares, at an average price around $20.79. They still have about $30 million left on their current buyback authorization.
Okay, good to know. So let's wrap up with the outlook. What's the guidance for the rest of the year? Did they change anything given strong Q1?
This is key. Despite all the uncertainty of the macro stuff, tariffs, they're reaffirming their full-year earnings per share guidance, still expecting $1.30 to $1.70 per share.
Holding the line on EPS, what's baked into that?
Basically, the current level of tariffs and their expected mitigation, some continued consumer caution, the Q1 beat, a slightly helpful foreign exchange rate now, and the impact of fewer shares outstanding from the buybacks. Big caveat, though. It assumes tariffs don't get materially worse, and their plans work.
Okay. What about sales guidance for the year?
A slight tweak there. They now expect full-year comparable sales up 2% to 3%. That's down just a touch from the previous 2% to 4% range.
A bit more cautious on comps then.
A little, but total sales guidance actually improved slightly. Now expected up 1% to 2% versus flat to up 1% before.
Wait, comps down slightly, but total sales up slightly. How does that work?
Foreign exchange. A more favorable outlook for the British pound sterling is expected to add about $15 million to reported revenue, boosting the total sales number even with slightly softer underlying comps.
Ah, the FX impact, got it. And the timing of those comps through the year.
Stronger comps expected in the first half because it's comparing against weaker numbers from last year. Then moderating growth in the back half when the comparisons get tougher, especially for journeys. They also signaled being a bit more conservative on comps for SHU and J&M specifically.
Okay. Any change to gross margin outlook for the year?
No, holding steady there too. Still expect full-year gross margin down slightly, 20 to 30 basis points. The thinking is that tariff impacts will be mostly offset by mitigation and decent margins in the retail segments.
And SG&A for the full year.
Still expecting leverage there. Adjusted SG&A as a percent of sales should improve by 50 to 70 basis points, mainly due to cost savings offsetting any slight pressure from the lower comp outlook.
Okay, what about the near term? Any specific guidance for Q2?
Yes, they gave some color on Q2. Expect overall sales to be slightly better than last year, mostly thanks to that FX tailwind helping offset store closures. Journeys and J&M comps are apparently tracking similarly to Q1 so far.
But SHU might be softer.
Yeah, SHU expected to have a softer Q2 comp, partly due to timing of a sale last year and partly due to some initial tariff impacts hitting that UK business.
And Q2 margins and costs?
Q2 gross margin expected roughly flat to down a little as tariffs start to bite, but are partly offset by mix. The bigger impact is expected on SG&A in Q2.
Oh, why is that?
They're pulling forward some marketing investments into Q2 to support campaigns later in the year. Doing that in Q2, which is a seasonally lower sales volume quarter, plus the lost sales from tariffs, means SG&A will likely deleverage grow faster than sales by about 100 to 140 basis points.
Okay, so higher costs relative to sales in Q2. What does that mean for Q2 profit?
It means Q2 operating income is expected to be about $6 million lower than last year. And that translates to roughly 40 to 50 cents lower in adjusted EPS for Q2 compared to last year's Q2. Interest costs also expected to be higher again in Q2.
So Q2 looks like it might be a bit pressured compared to last year.
Seems that way, yeah. A temporary dip expected due to the timing of investments and the initial tariff hit before mitigation fully ramps up.
But they expect things to improve in the back half.
That's the message. They believe they'll be better able to mitigate tariffs later in the year. They expect stronger demand around back to school and holidays, and renewed cost efforts should help drive leverage again, offsetting that Q2 pressure.
So confidence in the full year plan remains despite a potentially bumpy Q2.
That's the takeaway. Confident they can grow despite the headwinds, excited about the opportunities, especially at Journeys, and seeing this year as another step towards getting back to peak profit levels eventually.
Okay, so let's try to summarize this whole deep dive then. Genesco puts up a solid Q1, beating expectations. Journeys is really the engine here, with strong comps driven by that strategic transformation.
Definitely. And they're actively tackling big challenges. Tariffs, a cautious consumer with specific plans for mitigation, cost control, while still investing in growth drivers like those Journeys 4.0 stores.
Right. There's expected pressure in Q2, particularly from tariffs starting to hit and the timing of some investments.
But they're holding firm on their full-year earnings guidance, which signals, confidence in navigating the rest of the year and continuing on that path towards recovering profitability.
Okay. So that brings us to our final provocative thought for you, the listener.
Yeah, something to chew on. Considering how much positive impact they're already seeing from those Journeys 4.0 remodels and the whole shift to premium athletic, driving prices up, how much of their future growth really depends on just scaling those things, more remodels, more hot product?
Versus, how much could it all be capped or constrained by factors outside their control, like the overall health of the teen consumer's wallet, or broader macro pressures like inflation, or if those tariffs really stick around or get worse? Where's the balance there?
Something to think about.
Definitely.
Yeah.
And that brings us to the end of this deep dive.